Todd, let's start with you because September often has a bad reputation with investors. First 2 days have already been volatile. Where are we from a technical perspective?
Yeah. Hey, Leslie, great to be with you too, Bryant. I would say, listen, we're in an equity market globally that's at all-time highs. I think it's really interesting. You've started to see a little bit of a pickup in equity ETF flows. A little other sentiment data of ours starting to percolate. I would not call it a massive risk yet, right? Sentiment's getting a little bit hotter, and that makes sense with stocks at all-time highs. But so far, we're still in pretty good shape. Risk appetite is good. I think the real lull will happen further in the fourth quarter when there's really good seasonals historically. I would think there'll be a little bit of a chase in the equity ETF market too. And that's when people can get hit with a speed bump of sorts. Perhaps not too dissimilar like we saw back in April. It won't be as quick and as big as a drawdown, but that's what's on our radar. Again, things are in good shape. Equity ETF flow is rising, but not a massive risk just yet.
Yeah, and it's pretty remarkable. The rebound we saw from April, we'll see if that can repeat. Brian, many investors think a Fed rate cut is locked in later this month. Obviously, that would potentially be some kind of a tailwind for stocks if not already priced in at this point. But you don't think it's necessarily a lock at this point. Why is that?
Well, I think the market's overpricing the odds of a cut. I think the odds of a cut that's the base case is a cut. But the reality is the Fed is still behaving in a very data-dependent manner, and inflation is still safely above target, and there's uncertainty about the level of impact on tariffs on inflation. And so I think from that point of view, the Fed has every reason to just wait for more data. Now, on the other side of the mandate, though, employment clearly is weakening, but the headline numbers, unemployment rates, look quite fine, quite healthy, and so supply-demand is in balance. But under the covers, we're seeing fewer openings. We're seeing certain demographics like new college graduates having a hard time finding employment. And so I think a forward-looking Fed, which we don't traditionally have, a forward-looking Fed would say, look, I see deflationary pressures maybe 6 to 12 to 18 months down the road, which will save us on the inflation side. And I see employment already weakening under the covers. I can cut rates here. That's what they probably do, which would be a shift for the Fed to forward-looking. But from a data-dependent standpoint, they don't have to cut if they don't want to in September.
Yeah, important to make that distinction there. Todd, on a sector level, where has the money been flowing? Where is the most interest right now?
Yeah, so we're talking about rate cuts with Brian. What we like to do is take stock of where flows have been since the first cut almost a year ago. And the bulk of money has gone to technology. And I think that's been warranted, right? Tech stocks have been pretty strong. And then B, financial stocks. Maybe that's a derivative of the AI play. I can understand financial companies using AI as a productivity boost. But where they are not also going is defensives. There has been absolutely no demand for defensives, whether it's healthcare and staples and energy to some extent. So I think if you're looking for corners that are desolate, look at healthcare. And if you're looking for corners that are popular but maybe have a risk brewing on the horizon, it's going to be financials and tech. And in the meantime, you have a lot of just kind of noise in between there. So we always like to cue off of where the cyclical flows are going. Again, similar to the broader market rising, but not necessarily a major risk yet. I would punt that until later in the fourth quarter before we start even to think about warning signs.